venture capital, private equity, they only fund about 2% of the deals that come to them. There's still a huge demand out there for companies looking for capital. One of the big promises of crowdfunding to open up this kind of opportunity for entrepreneurs, small businesses that are looking for money that really can't get traction yet with the VCs of the world on an equity crowdfunding deal. There are a number of companies that have raised the $5 million.
Hi, welcome to another episode of the Business with God podcast, where we strive to help young Christian men encounter the heart of the Father, get to know what God has called them to do, and then be equipped to pursue the amazing dream that God's placed on their heart through business. Today, I have the honor of welcoming Jerry Fultz to be a guest on the podcast. He's been in the redemptive business space for quite a few years. He's been part of a team most recently that launched a startup called EquityVest, which is a crowdfunding platform. It helps provide capital to faith-driven entrepreneurs. So I'm really looking forward to getting Jerry's insights, not just on financially supporting a business, funding a business, all of those different pieces, but on just walking out business in partnership with God in the redemptive business space in general. But Jerry, welcome to the podcast.
Thanks for having me. Good to be here.
Awesome. Could you briefly explain like what is equity crowdfunding? Because I think it was a new term to me.
Sure.
And I know there's different ways of funding. You can privately fund your business. People know what venture capital is, right? And people know what GoFundMe is, but I don't think a lot of people have a deep awareness of just what that term even means.
Sure. Yeah, and that's totally understandable because this whole industry has only been legal really for about the last 8 years. It's still fairly new. So pretty much everyone knows what crowdfunding is. GoFundMe, for example, is a site that's used oftentimes if you're trying to raise donations, specifically donations for maybe medical expenses. And then you've got maybe a tick up from that, which would be the Kickstarters, the Indiegogos of the world, and there too, you're asking for donations to help fund a project. It's very popular to use those for bands that are trying to maybe release an album, right? And so what they'll do is say, if you kick in a few bucks, we'll give you a free copy of the album. So it's kind of a premium base. You get something out of it, but it's certainly not a financial return. So then the step up from that is true actual investment, where you're asking for investment in your company in return for a possible financial return. And so because of that, because these are active, actual U.S. securities, this all falls under the purview of the Securities and Exchange Commission. So then I guess back to your question. Then there's a lot that you can and cannot. There's a lot that you cannot say in terms of self-promotion about the industry once you're actually a platform that people are using to raise capital. There's a lot that you can't say about the companies. You can't really promote the companies. You can't promote the companies at all that are raising money on your platform. We as a platform cannot invest in the companies that are raising money. Basically, at the end of the day, the way the SEC has set this up is that we are just a dumb platform. We are the technology that allows people to come to our site to launch a capital raise. And so our role in all of that is to build a platform, make sure it's up and running, functioning properly, and then it's a big compliance role. We go through what your pitch deck would look like, what the terms of your offering are, and just make sure that they are all on the straight and narrow with the SEC so that you and we and nobody else gets in trouble. So anyway,
let me ask a follow-up on that. What's the difference between somebody investing through EquityVest, for example, or buying, let's say, like a partial stock in a company that's already public?
Well, and I think that's the key word right there. These are not public securities. They are not publicly traded securities. So
it's not considered a public company if somebody gets investment through this platform?
Right. I mean, there's plenty of examples where people have used crowdfunding in the early days to help get launched, and then maybe they've had some follow-on funding through angel investors, through venture capitalists, and maybe even eventually launch an IPO and go public. But it doesn't work the other way around. These are not public securities. They aren't traded on any exchange. As a matter of fact, one of the rules is that you're stuck with them for a year. You can't do anything with them for a year. And so it's private equity. It's a stripe of private equity.
So are you able technically to sell that after the year? Just thinking about from the investor perspective, or not really?
No, and so this is where it all comes down to your term sheet, and all of this is spelled out, what you can actually do with the securities, and it varies from deal to deal. And so all of that is spelled out, and it has to be very transparent and open about what you can and can't do with the investment. So in some cases,
so it varies.
Yeah, it varies from deal to deal, just how exactly you want to set it up. So there's a variety of different things that you can do, but you are basically limited. You can't do anything with it for the first year. So
okay. So what would lead a company to seek funding, for example, on this platform specifically? I know a lot of entrepreneurs or wannabe entrepreneurs I've chatted about, everybody's wanting capital.
Sure.
And people talk about, the dream scenario, if somebody would just hand me $1 million, I'll build a successful business. And it's like, well, I don't think that's how that works. I don't think you can just say, I've got a great idea, give me money. There's probably a lot more to it than that, but I'm just curious if you could unpack that a little bit more.
Yeah. So I think the question is why would people use an equity crowdfunding platform? So let's just take a step back and talk about the landscape, maybe of raising capital these days. Really since the 1930s, this whole area of private equity has been governed pretty heavily by the SEC, and the reason is this goes back to the 1929 stock market crash. And then the depression that followed. And so the SEC put in a number of rules at that time, almost 100 years ago now, that these private equity markets were going to be limited to accredited, or in other words, high net worth individuals. And the assumption there was that these folks were savvy about investment, could afford to lose their investment, but they also assumed that just the average Joe out there that makes up 95% of the population doesn't really have the financial chops to understand what this is all about. And so they restricted this whole arena to accredited high net worth investors. But then
I'm tracking with that, but I'm curious if you don't mind me asking a question on that.
Mm-hmm.
Were there practices that led to the Great Depression that like SEC response actually solved for?
I'm not really the historian. I can't really tell you exactly, what market conditions led up
Sure,
to.
And that's fine. I'm just curious.
So, that's okay. Awesome. I suppose at some point I should do some deeper digging into that, but I have not. So.
Oh, that's fair.
Right.
Yeah. So
but anyway,
I still want to hear though the overall context that I didn't mean to cut you off. Right. You were talking about how the assumption was the average person doesn't necessarily have the financial know-how, and I feel like that assumption isn't totally wrong to invest in a business. But I'd love to hear more.
Right. No, you're right. If you don't spend a lot of time in this space, right, then you don't really understand all the risks and everything that's involved with it. So, I'm not really complaining about the law or the way that it was set up. That's just what happened in the 1930s. Mm-hmm. But then you roll around to, the 2000s, 2010s, and the truth of the matter is that venture capital, angel capital, private equity, the truth is even now they only fund about 2% of the deals that come to them. And that's actually good data. You can go to their, so to speak, their Bible, the venture capital Bible. It's called Pitch Book. and just kind of see how all of that stuff is working out in terms of the deals that come to them and then the deals that actually get funded. And so if they're only funding about 2% of the deals that are coming to them, it certainly seems like there would be ample opportunity for other players to step into the space. So having said that, there's a lot of deals that should never be funded, right? And there's a lot of deals that just frankly are bad ideas and should never be funded. And venture capital certainly provides a huge service there to help kind of weed out, what those companies are. But still, having said that, I mean, that average venture firm, I mean, they're tied to a certain set of criteria about who they're going to fund, who they're not going to fund, kind of the industries that they want to be involved in. And so there's a lot of guardrails up, even within venture capital, about, who they're going to disperse money to. So having said that, there's still a huge demand out there for companies looking for capital. Again, some of them, maybe the majority of them, aren't actually deserving of capital. Their business idea is no good, or they don't have the leadership team to pull it off, or the IP to make it happen. But there's still a good number of companies that are out there that do meet those minimum requirements, that are maybe worth a risk, right? But they fly under the radar of the venture firm. And just a good example is that, startup companies, depending on, the industry that they're in, I mean, they may not necessarily need, a $10 million check, to get started. A lot of these companies fly under the radar or the minimum investment requirements of the venture capital firms. And so there's actually, a lot of those companies out there. And so anyway, all this kind of came to a head maybe 15 years ago under a thing called the Obama Jobs Act. And what they recognized as a part of that act is that if we can make this whole thing transparent and make it so that the average investor, the average Joe, the 95% of the folks that are out there can actually fund these kind of companies. But if we can do it in a transparent way, in a way that helps to educate them so they know what they're getting into, that they're aware of the risks, that this whole process of actually going out and floating a security deal can be standardized, from company to company, so that we can daylight the entire process, then why not open it up into a crowdfunding kind of a mechanism? So that's what happened. They passed the law in 2012. Took about 4 years for the whole thing, all the rules and regs to get written. And then in 2016, it went live.
Wow. So if it's been live for, I guess, almost 10 years at this point, not quite, are there any companies, and it's okay if you don't know, but I'm just curious if there's any companies that people might know or might have heard of that have been crowdfunded in this way? Maybe not through EquityVest, but just in general, that wouldn't be here without that type of funding. That's just, it's really interesting that mechanism is so new and so little known to me. Right. I'm just curious if it's behind the scenes with some kind of name brand companies that are more new on the scene these days.
Well, and the answer is yes. The one that I was just working on this earlier today, there's a platform out there called Substack that, is kind of gaining a lot of traction. A lot of people aware of Substack. And they raised a good chunk of their money through a platform called WeFunder, doing a equity crowdfunding deal. So that's just the one that immediately comes to mind. They've done follow-on financing.
I know a lot of people who are aware of Substack. That's really interesting.
Right. Yeah. So if you were to go out to wefunder.com, and I just looked at this 3 days ago, it's still up there. Substack is still one of their feature companies. I mean, you'll be able to find information about the deal that they did on WeFunder. The deal's closed now. Yeah. They actually raised a good chunk of money through equity crowdfunding.
What's the upside? Let's say somebody is more on the investor category, and let's say I don't know how much money you need typically minimum to join a deal, but let's say best case scenario, they've got a chunk of money to throw at a deal. They find a business they're really passionate about, maybe on EquityVest.com. And, I don't know what the hoops are to jump through as an investor, but what's kind of the upside possibility? And obviously it's not guaranteed. Every investment has risk.
Right.
You could get zero return, but But what's the benefit if, like, as opposed to throwing something in real estate? Like, people talk all about, hey, invest, throw stocks in something. Literally this last weekend, you might be blessed by this. It's kind of funny because a lot of pastors won't talk about it, but our pastor was talking about just financial wisdom, and he threw up on the board an image, and it was, here's stocks, here's dollars, here's gold, here's silver, here's investments, here's running your own business, here's real estate, and then here's ownership in a business. But kind of fractional ownership in a business isn't something that people talk about a ton. You usually have the stocks or you're owning your own business. But I guess I'm curious, like, is this a new investment opportunity out there as well that people would be wise to consider at least?
Well, I'm not going to say they would be wise because they know be giving financial advice, and I really,
Yeah,
I
we'll
don't know
put a
if it would be
disclaimer
wise
at the
to give
bottom
it
of
up.
this.
Right? Yeah, right. Big
Maybe
disclaimer.
you'd be wise to look at it, but it's on you if you think it's
Exactly.
wise to do
Exactly.
it.
Yeah. Let me kind of throw some numbers at you and just a little bit more about what this whole thing's about, right? So,
Sure.
a uh, a person or a company, an entity that wants to come and raise money through equity crowdfunding, you can raise up to $5 million in a year. Okay, that's the max that you can raise. You don't have to raise that much.
Hmm.
Matter of fact, you can determine. What we found, if you want to raise less than 100,000, it's probably not going to be worth your time. But really, that whole space between 100,000 and 5 million is fair game. The average raise, and we know this across, and it's interesting because I mentioned 2016 we went live. Uh, we've got kind of our own data nerds in the industry that have tracked every single deal that have ever been put on any platform, and so we know that the average raise is around. It's gone up just a little bit recently, but it's around $375,000. That's what an average raise is on an equity crowdfunding deal. There are a number of companies that have raised the 5 million. There are a number of companies that kind of in between all that, 100,000
Hmm.
to 5 million. But the average raise is 375. So there again, you can kind of see that really flies under the radar of a lot of venture capital firms, right? I mean, that's
Yeah.
just small potatoes, to a lot of these guys. And so uh, the average person on what'll happen when you come to a platform like EquityVest or WeFunder or any of the other ones that are out there is that you'll just be asked, are you an accredited investor or are you an unaccredited investor? A lot of people won't even know the answer to that, but there's usually just like a two question simple process that identifies you as accredited or non-accredited. And either way, you're fine, just so long as you declare which you are. You're eligible to invest. The
Okay.
average deal, well, I'll tell you what, the law really allows a minimum investment basically of $100.
Oh wow.
You can go at $100, $1,000, $10,000, $1 million. It's really just kind of whatever you want to invest, but it can go as low in most deals of $100. Now, a lot of deals will put, I don't want to say a lot, but some deals will put a minimum on there, like they don't necessarily want anything less than $500, but that's not necessarily the norm. I mean, the whole point of crowdfunding is to attract, the masses. So if you've got $100 again, 500, whatever it is, they'd be happy to work with you. So
Yeah.
now, did that answer
It's
your
kind of a
question?
numbers
Just
game
about,
at that point, right? Is if you can get enough people to throw $100 in there, that's a lot of money.
right? Yeah. So, and that's the idea, is to open up this kind of opportunity for entrepreneurs, small businesses that are looking for money that really can't get traction yet with the
Hmm.
VCs of the world, or just are just you know so many companies come and maybe they're just at the point where they're trying to build their prototype, right? Or maybe they're
Yeah.
trying to build an app, and those things they can be anywhere from 100,000 to 500,000 to $750,000, right? And
Hmm.
so what's really cool about this, or one of the, I guess one of the big promises of crowdfunding is that if you have a crowd that you can bring with you, like, maybe it's just friends and family, but maybe a social media crowd or an email list, or maybe somebody's been following you, through your journey so far about what this thing is that you're building, whatever it is. I mean, they can now become, they can now say, I'd love to be in on the ground floor of that thing, and for $100, $500, they can do it. And there again, it's kind of the psychology of it, but when you're just giving $500,000, $1,500 to somebody, typically you kind of look at that as maybe just a donation. I mean, that you may not ever get anything back out of that, but it's nice to know you could, right? It's nice to know that maybe this latest widget will take off, and then you kind of get the dual satisfaction of enjoying some financial return, as well as just seeing your buddy, your pal, or this guy about actually launch their product, right? So yeah.
So let's say it's wildly successful. I put in $1,000. This business was wildly successful. It's not like a stock where I'm paid dividends necessarily, but a year later, what happens? Like, if the company itself goes public and sells, do I get paid the value of whatever share I put in, or like, how does all that work in terms of actually getting a financial return as an investor?
Yeah. So, we'll get a little bit into the weeds here, and we can certainly talk more about it later. But I guess what I would say is that both companies, businesses, for-profit businesses and nonprofits can use this vehicle. They can issue debt, just a debt instrument, just a note with a stated rate of return. The most common practice you can use a convertible note, number of different things you can do there. The most common practice is to use this thing called a safe note. And this is the thing that was made possible by a lot of the really large incubators like Y Combinator, Techstars, those kind of folks. And basically, a safe note is just an acronym. It means simple agreement for future equity. And so, there may or may not be declared in the initial documentation, just what the company's valuation is. But the point is that at some future event where you're either going to, typically you're going to get bought out, or you're just going to grow and then, repurchase the stock all on your own. There's going to be some kind of a funding event. Simple agreement for future equity. Simple agreement for future equity. There's going to be some kind of a funding event, at which point then you'll be able to cash out, or you'll be able to. The deals can all be structured differently. I mean, there's a huge amount of customization that can happen.
Oh wow! Okay.
With how and when and where you're going to have a liquidity event. So right.
Okay. But so it sounds like it could be something where the business itself sort of buys back that equity from people and therefore gives them a return, or the business goes public, or the business sells itself. And in those funding events, which that's a term I'm new to, so you'll have to forgive me if I'm using it wrong. Right. But if those are funding events, that's when I, as an investor, would have a chance at a return depending on the new valuation.
Right. And so, having said that, and I want to be a little bit careful here, but I mentioned that there's no real secondary. I mentioned that there's no real secondary market for these kinds of these kind of investments. There's no stock market sitting out there, but that is something that's being actively pursued now, especially like most laws. I mean, they're in a constant revision, and this is one of the things that they're looking at pretty hard right now, is this development of a secondary market where these things can be traded. That's not here yet, and I'm not totally up to speed on it. I just understand it kind of from a high level, but that's one of the things that's coming. But in lieu of that, yes, you're basically waiting on some kind of a future liquidity event.
Interesting. So it seems
sense.
Like at a core, one of the most valuable aspects of this, because there's businesses that are fully bootstrapped, that people just
Yes.
start and run with. Those are usually in the service type
Mm-hmm.
businesses where uh, you're either going out and doing carpentry work, plumbing, or you're online doing marketing or consulting or contracting type things. There's all kinds of different stuff you can do in that realm. Are these mainly in the product or invention side of business, or so like if you could give me some examples? I know any business can use capital. Like I know that principle is true.
Sure.
Um, but I'm just curious if you give me some examples of the types of business that can use this range of capital. Like somebody's inventing an app or they have a great idea for a software. It sounds like all of that. I'm sure it's a
Mhm.
million things, but I'm just
It
curious to get a
is.
couple of potential examples.
Yeah. And again, yeah, it's this approach is really kind of industry agnostic. It can be applied to whether it's ed tech, healthcare, anything. I think one thing might be helpful is that three deals that we've done recently on EquityVest might illustrate the point here. So one was a nonprofit that's in the affordable housing space that is doing affordable housing things in the Bay Area, San Francisco, California. A second one was for a rideshare company. It's a alternative to Uber and Lyft that really is doing it's really starting to get some really good traction in the Phoenix area. It's called Hum. That was kind of their first test market, and they've got just all kinds of. I don't know what the exact numbers are, but they might be approaching 1,000 or more drivers that are on their platform
Wow.
now, just after a couple of years, and
What's it called again?
really interesting. It's called Hum, Hum, Hum
Okay.
Rideshare, and
Nice.
they raised money on our site. They were already existing; they were up and running, but they needed to uh, get a good chunk of change to really expand their footprint. So a lot of that money went into marketing for them, trying to attract both drivers and riders. So it's primarily kind of a marketing play for them.
Yeah, that makes sense.
And then we had a group out of the Midwest that's doing kind of a farm to table ranching operation that has kind of a unique spin on that. And they ended up raising a couple $1 million to buy their herds and get everything going that they needed. And I think they're getting ready to do a follow-on round with us there as well.
Wow.
So those are three examples: affordable housing as a nonprofit, and a for-profit rideshare company, a ag company. But I mean, whatever so many things now are AI. A lot of things that are AI development, all kinds of apps. All those tech
Hmm.
areas are certain areas that have raised money through equity crowdfunding. But it can be a B2B kind of an approach, business to business thing that you're building. It can be a B2C, business to customer. All those things have successful raises. So yeah, it's really just kind of a matter of what you want to do and if you've got a crowd that you want to work with.
Yeah. Well, that's really key, the part about the crowd, because it sounds like if I'm driving to work one Monday morning and I have a great idea, that isn't the time to take it
Mm-hmm.
to EquityVest and to get my idea funded, because an idea is not a
Right,
business. Uh,
right.
right. And one of the things I've been reflecting on a lot lately, you and I talked about this a bit before, is the importance of actually taking your idea and applying some innovation principles to it, bringing it in front of the people
Mm-hmm.
that you'd like to sell it to, figuring out, is this a viable business idea?
Right.
I love the term model, business model, because then you've
Mm-hmm.
thought about the different pieces that have to be in place. At what point does equity crowdfunding either become an option or become something you should consider, because you have to have perhaps a viable business concept. You have to have some sort of audience that you can ask them for money, and then you give them this vehicle as a way to give towards, not give
Mm-hmm.
towards, but invest in bringing that idea to
Mm-hmm.
market. But it sounds like there's some
Right.
pieces that have to be in place first. What would be your advice to somebody who says, "Hey, that sounds really interesting. I want to learn more about it. I don't know if I'm ready for that or not. How would they know?
Right. Right. Okay, let's talk specifically about crowdfunding here,
Mm-hmm.
okay? Because the key is the crowd, right? That's that's why you're not going to a venture capitalist that can just write the one big check, or a group that can write, the couple big checks. You either can't get their attention, or you're not ready, for them yet, or you don't fit into their, kind of prescribed guardrails that they want to fund, right?
Mm-hmm.
So crowdfunding implies that you have a crowd. So one of the big myths that we kind of have to destroy just right out of the box is that as a platform, as EquityVest, for example, we do not bring your crowd. Okay.
Mm-hmm.
The crowd is your crowd, and it's the crowd that you are going to go out and market to, or make aware of what it is that you're building. And so you basically have to have some kind of a crowd that is going to follow you into this deal. So, uh, and there's every platform's a little bit different. Some platforms do vet some accredited investors, but your deal has to be a primo deal before they're going to float it out in front of their, very well-heeled and seasoned investors, right? So,
Yeah.
for the most part, people will come to us when, oftentimes they're ready to build their prototype, right? But they need the money to build it, or they need to get their proof of concept, whatever it is that they're working on, established,
Yeah.
whatever that might look like in whatever industry. So you've got a crowd, you've got basically a vetted business model, and you've got a product or a service that actually is going to be a benefit, right, to somebody. So you have to have done all that homework pretty much prior to coming to a platform and saying, yeah, we're ready to go. So,
Yeah.
uh, yeah, a crowd, a viable product, and then whatever the third thing was, I just
Well, you said a
escaped
vetted
my mind.
business model, and I'm
But
assuming as part of
right,
that would be you have to bring the team that's going to run with this. As part of this crowdfunding, you don't all of a sudden get a new COO
pretty
added
much,
to your
yeah,
team or anything like that, right? That's not really
yeah.
part of
I
the
mean, it's
investing side.
there's solopreneurs out there for sure. There's a lot of solopreneurs that have used this kind of a model, right? But
Really?
but
Huh.
you're going to put
Okay.
together a pitch deck that's going to that's that's going to outline the terms of your deal. What it is that you're using the money for, how you're, and then as a part of that, I mean, pretty much every pitch deck will have, here's the founder, here's the marketing guy if you've got one, here's the chief technologist if you're in some kind of a tech solution. But there are definitely solopreneurs that use this all the time. So it's really just what you're doing and who's on your team. So
Yeah. Wow. I think that it's really interesting because to me, there's a clear opportunity here for somebody to want to do crowdfunding, but to need to do their homework ahead of time. I'm curious if somebody was
sure.
in that position, would potentially them connecting with you, would you be open to that? Or what would your advice to them be, I suppose?
Yeah, sure. Yeah. It's, I mentioned that I'm not working with EquityVest anymore. I helped to launch
Hmm.
it, but now I'm not
Yeah.
a part of the team. I've kind of moved on, so I actually have a lot more freedom now than I did when I was actually working for the platform. So yes, I am more than happy to, meet with folks, kind of walk them through what this process looks like.
Hmm.
Anytime you're raising capital, I mean, I'll just let you know this is maybe in some ways easier than trying to find a venture firm that will back you. But
Yeah.
anytime you're raising capital, it's just hard work, right? I mean, you're going to
Yeah.
be putting in some time to make this happen. And in the case of crowdfunding, because it's all under the purview of the SEC, right? You're going to be filing some paperwork, and you're going to be jumping through, just a number of other hoops just to make sure that your deal is ready to go public. But yeah, I can walk you through all that kind of stuff, right? So sure, yeah,
Wow.
coach,
That's awesome.
coach
Well, if
through that kind
that's
of
if
thing.
that's good with you,
Sure.
I'll put a way that people can find you, connect with you, down in the
Sure.
description below. We are coming up
Sure.
to time, but before we close, I do want to make sure to touch on what sets EquityVest apart from some of the other platforms that are out there.
Great question. And yes, there's about 50 platforms that are out there doing this equity crowdfunding piece that are approved by the SEC and all. What the SEC does allow, I mean, some of the platforms will just take all comers. It doesn't matter what industry you're in, just anybody can float a deal out there. But then there are platforms that specialize. So some, for example, might specialize, say, in healthcare, others in real estate, whatever. There's various stripes. But our whole ethos, really our whole DNA is about faith-driven individuals, faith-driven entrepreneurs, faith-driven founders. And so we went to the SEC and made the case that we would really like to, as much as possible, deal with the faith-driven crowd. So they didn't know exactly what to do with that for a while. It took us some back and forth, played ping pong, a lot of back and forth with them, but finally they signed off on it. And so now if you go to our site, you'll see that the folks we're really trying to work with are folks that are aligned with Judeo-Christian values, faith-driven entrepreneurs, faith-driven founders. And so, and just real simple, in our application form, we don't have anybody sign a statement of faith, but we lay it out there pretty plain that, if you want to be successful on our site, those are the kind of crowds you're going to have to attract. And so we just ask people to say, just kind of, hand on a Bible, raise your right hand. Do you agree with these kind of values? I mean, do they resonate with you? And so if they do, then, you finish the application. It goes through just a very brief approval process, and that's that. But anyway, that's what sets us apart. That's our niche. That's who we really want to be working with.
That's awesome. Any other thoughts or encouragement for people who may be considering going the crowdfunding route?
Well, you have to do your homework. I think we even mentioned before that anytime you're raising capital, it is a chore. It's a battle. You have to get informed. So, I mean, I personally am happy to just, talk with folks individually, just kind of offer up what I know if anybody wants to, get in touch with me. It's all a process. This is a fairly new thing that's out there. It is different than approaching venture capitalists. It is different from certainly just asking for donations, that kind of thing. So there's some paperwork you're going to have to do to file with the SEC. There's some very basic kind of financial stuff, and if you're a pure startup, you don't really have any kind of a financial history. It's all just going to be zeros, but you still have to get somebody independent to attest to that, and a few other hoops you have to jump through. So I can help people kind of streamline all of that piece of it.
Awesome.
I just think that the industry in itself is really starting to mature, and it's starting to see a lot more adoption. Just for example, I think we mentioned earlier as an example of somebody that's actually raised money on doing the crowdfunding piece. I did go out and look at the numbers for Substack just while we were on this call, and they've done a couple of raises. They've done some private equity, that kind of thing. But between I think the couple of raises they've done through crowdfunding, they've raised $7.2 million over time, and that has come from over 6,000 investors. And so I just did the quick math, and you can see that the average investment is around $1,200, and I think that kind of lines up with what we were talking about earlier. So
for sure,
it is very possible to raise a good chunk of change through a crowd, but you have to kind of butter up your crowd. I don't like that word, I guess, but you've got to prior to doing a raise, you got to start letting people know through your social media channels, your emails, that kind of thing. We're thinking about doing this. It's coming down the pike. Just we'll be sending more information on it. Just all of that. So those are all the kind of things that actually go into getting this thing done and getting it done well. So, and obviously,
that's awesome.
Not everybody's going to raise $7 million, but the average raise, like I mentioned earlier, is around 350, 375K. So, yeah. Anyway.
Well, it could make a big difference in bringing some awesome business ideas to market that would be overlooked by venture capital or somebody can't self-fund. So that's really quite cool. I appreciate you coming on. I will make sure to have all the links to EquityVest and also to Jerry, to your LinkedIn, if people want to connect with you as well, in the description down below. And if you like this episode of the Business with God podcast, make sure to comment what you got out of it and subscribe for more.